The average American woman retires with 30% less savings than her male counterpart, outlives him by more than 5 years, and faces healthcare costs that run structurally higher every year of that extended life. But those 3 facts in isolation don't tell you the mechanism. The mechanism is what nobody puts together in one conversation, because the 4 financial traps that hollow out women's retirement security don't operate sequentially. They compound against each other in the same decade, in a way that makes each one exponentially harder to escape than it would be alone. And the decade when all 4 hit simultaneously is the 50s, not the 30s when there's time to course correct, not the 40s when the portfolio is still accumulating. The 50s, when the runway is short, the math is merciless, and every locally rational decision made over the previous 20 years has already been recorded by a system that doesn't grade on a curve. This is not a video about women making bad financial decisions. It is a video about women making reasonable decisions inside a system that was designed for someone else's life trajectory entirely. And the gap between those 2 framings is where about $300,000 tends to disappear. Today, I'm going to walk through the 4 structural mechanisms, not just list them, but show you how they interact with each other. Because the interaction is the point. I'm going to do the actual math at each stage. And I'm going to explain why the standard financial advice that gets handed to women in their 50s not only misses the compounding nature of these traps, but in some specific cases, actively makes the outcome worse. The through line I'll use for all of this is what I'm calling the invisible mortgage. Hold on to that concept. It gets more useful as we go. Here's the invisible mortgage idea. When you take out a real mortgage, you know the terms. You sign a document, you know the interest rate, the duration, the monthly payment. You can model it, plan around it, refinance it if conditions change. The invisible mortgage works completely differently. Nobody signs it, nobody discloses the terms. The payments are extracted from your future net worth rather than your current checking account, so you don't feel them accumulating. They're quiet. And then somewhere around age 55 or 57, you sit across from a retirement planner, and she runs the numbers, and her expression does a specific thing, a tightening. And she says, let's look at some options. What she means is that the invisible mortgage just presented its full balance due. The American retirement system charges women an invisible mortgage for 4 compounding reasons. The first is the Social Security architecture. The second is the gray divorce cliff. The third is the caregiver compound effect. The fourth is the longevity math that almost everyone does wrong. All 4 are operating simultaneously in the 50s. Let me take them in order, but not in the order you'd expect. In a few minutes, I'm going to show you why the gray divorce cliff is the single most financially catastrophic event that can happen to a woman in her 50s, and the reason is not the one you're thinking of right now. But first, I need you to understand the Social Security architecture problem, because everything that comes after builds on this foundation. Most people understand Social Security at the surface level. You work, you pay into the system, you receive a monthly benefit when you retire. The amount depends on your lifetime earnings. That's mostly accurate. Here's what most people never learn until it's too late. The Social Security Administration calculates your retirement benefit based on your 35 highest earning years. Not your working years, not the years you paid in, your 35 highest. If you work for 30 years, 5 zeros get averaged into the calculation. If you work for 27 years, 8 zeros, those zeros get mixed into your earnings history and mathematically drag your monthly benefit downward in ways that almost no one thinks to model until they're looking at their first official estimate and wondering why the number is lower than expected. Now think about whose work history most commonly contains those gaps. The Bureau of Labor Statistics tracks workforce participation across decades. Women are approximately twice as likely as men to exit the paid workforce entirely at some point during their working years. The National Alliance for Caregiving estimates that the average American woman spends roughly 12 years outside of paid employment over the course of her lifetime. Not 12 years in a row necessarily, often interrupted stretches of 1, 2, 3 years, but 12 years cumulatively. That's 12 zeros getting folded into a 35-year calculation. Here's what that produces in real numbers. A woman who earned $56,000 per year for 23 years, then spent 12 years outside the workforce for various family reasons, raising children, caregiving for a parent, accompanying a relocated spouse, and then returned to work, will receive a meaningfully lower Social Security benefit than a man with an identical salary who worked all 35 years without interruption. According to the SSA's benefit formula, which is public and published and still somehow a shock to most people, your average indexed monthly earnings, the number the benefit is calculated from, gets dragged down proportionally by those 0 years. The Social Security Administration published data showing that in 2023, the average retired female worker received approximately $1,489 per month in Social Security benefits, while the average retired male worker received approximately $1,875 per month. That is a gap of $386 per month. Over a 22-year retirement, the median duration for a woman who retires at 65, that gap totals approximately $101,800 in lifetime benefits before cost of living adjustments. With those adjustments, the number is larger, but the detail that trips people up worse than the benefit gap itself is the spousal benefit rule. A lot of women in their 50s who know their own benefit is lower plan to claim the spousal benefit instead, 50% of their husband's benefit at full retirement age, because that number is higher than their own. This is a real option. It exists in the tax code. The catch: you only qualify for divorced spousal benefits if the marriage lasted at least 10 years. If it ended at 9 years and 11 months, the benefit evaporates. If it lasted more than 10 years, it survives the divorce, but then there are claiming rules, timing rules, coordination rules that interact with your own benefit in ways that most people discover for the first time while trying to make an irreversible claiming decision. There's a retired school teacher whose situation has been documented in retirement research published by academic institutions studying Social Security claim patterns. She taught for 27 years. She had 8 years out of the workforce, 4 when her children were young, 4 more caring for her mother-in-law. She expected a Social Security benefit of around $1,800 per month because her colleague with a nearly identical salary history receives $1,800. Her colleague worked continuously for all 35 years. The school teacher's benefit came in at $1,430 per month. The difference is those 8 zeros. She was not informed by her district's HR department. Her tax preparer never raised it. The SSA website does explain it. It's in the FAQ section, but she had no reason to go searching for a question she didn't know to ask. That is the invisible mortgage. First payment. Quiet. Routine. Recorded in a database somewhere while she was making decisions that felt like the only sensible ones available. By the way, hit subscribe if you like this. Otherwise, the YouTube algorithm may never show you my videos again. Now, this is where it gets genuinely alarming, because the Social Security trap is actually the smallest of the 4 in dollar terms. What comes next is bigger. The gray divorce, that is the demographer's term for divorce after age 50, is quietly becoming one of the primary financial catastrophes for women in the current generation approaching retirement. Here's the thing about the divorce rate trend that almost nobody mentions. The overall American divorce rate has been declining since the 90s. Younger couples are splitting up less frequently than they did a generation ago, but the divorce rate for couples over 50 has roughly doubled since 1990, doubled, while the overall rate was falling. And the financial asymmetry of what happens to men and women after a gray divorce is not subtle. Pew Research published analysis on this that deserved more attention than it got. After a gray divorce, women's household income drops by an average of 45%. Men's drops by 21%. Same divorce, split assets, 2 different financial trajectories. And the crucial distinction from a divorce at 35 is that at 55 or 58, there is almost no runway to rebuild that income loss before retirement. At 35, a 45% income drop is devastating, but survivable over time. At 57, with a 10-year window before the money needs to be sufficient without a paycheck, you're not rebuilding, you're managing a permanent reduction. You might think the financial problem with gray divorce is primarily emotional, the disruption, the legal fees, the cost of establishing a separate household. Those are real, but actually, the financial problem is something more technical and more specifically brutal. What asset division means at 55 is categorically different from what it means at 35. A financial planner in Atlanta wrote about a client in a professional journal that publishes anonymized case studies. I'll call the client Patricia. She was 56 when her divorce finalized, married for 22 years. During those 22 years, her husband had been the primary earner. Patricia had worked part-time through most of the marriage, managed the household, and had spent about 6 years entirely out of the workforce when their children were young. The divorce settlement split marital assets 50-50, which sounds equitable. Patricia received approximately $240,000. Her portion of the home equity, some savings accounts, and her share of her husband's 401k, which required a qualified domestic relations order, a QDRO, to divide legally. Most people have never heard of a QDRO. It's a court order that allows a retirement account to be divided in a divorce without triggering early withdrawal penalties. Without one, the division doesn't happen correctly. Attorneys who specialize in family law know about it. General practice attorneys sometimes miss it. Patricia got her $240,000. Her husband, age 58, retained the other half of the assets and continued contributing to his 401k at a salary of $112,000 per year for the next 9 years until his own retirement. His assets kept growing through contributions and employer match and compounding. Patricia's static $240,000 received no new contributions of significance because her part-time income generated minimal 401k contributions. Her human capital, her future earnings, was dramatically lower than his, and her Social Security benefit was already reduced by those 60 years in the calculation. When the planner ran the retirement projection for Patricia at a planned retirement age of 65, the picture was not optimistic. Here's the thing about the widow's benefit that adds another layer to the divorce problem. Had Patricia stayed married, she would have been entitled to the survivor benefit, the higher of the two Social Security payments, if her husband predeceased her. After divorce, if she hadn't been married for long enough, or if she didn't understand the claiming rules for divorced spouses, she might have lost access to that survivor benefit entirely. The invisible mortgage on a marriage that ended doesn't just affect the division of accumulated assets, it reaches forward into the future retirement income structure. And here's the reversal that changes the entire framing. You think the problem with gray divorce is the disruption of the marriage, but actually, the problem is that a woman who deferred financial decision-making during the marriage, which research consistently shows is the more common pattern in opposite-sex couples, arrives at the divorce without the VI, financial literacy, to evaluate the settlement correctly. She knows the dollar amount. She doesn't know the pension implications, the Social Security survivor benefit loss, the tax treatment of the transferred retirement account, or the long-term compounding impact of receiving a static lump sum versus an ongoing contribution stream. She accepted a settlement that looked fair on a spreadsheet printed the day the ink dried. The invisible mortgage was silently written into every line of that settlement. Here's what knowing these numbers and having a system around them look like in practice. And I want to be honest about how difficult that second part actually is. I built something called the exit code, specifically because I found that most of the data on retirement mechanics is publicly available and almost entirely useless without a mathematical framework to act on it. It's a digital book, 8 chapters, built on 50 years of actual retirement data, and 2 of the things I cover most directly apply to what we've been talking about in this video. The first is what I call the 58% rule, the documented reality that more than half of Americans who plan to work into their 60s are forced to exit the workforce earlier than planned, not by choice, but through layoffs, health events, or exactly the kind of caregiving obligation we're about to get into. The buffer you need to build against an involuntary early exit is not the number your advisor is giving you, and the math on why is in Chapter 2. The second is the dynamic withdrawal method, a framework that replaces the 4% rule by accounting for what actually happens to a portfolio when withdrawals start at the wrong moment in a market cycle, which is a risk women face disproportionately for structural reasons I'll explain shortly. If you've been told to max your 401k and wait until 65 and that's your plan, Chapter 3 is worth your time before you decide that's sufficient. You can get the exit code through the link in the description. It costs less than dinner out. The math in it took considerably longer to compile than a restaurant review, and every year without a framework means the compounding is running without you. Now here is the part that connects Social Security and the gray divorce into a third mechanism, the caregiver compound effect, and this one hides in plain sight. About 60% of unpaid caregivers in the United States are women, according to the National Alliance for Caregiving. When you focus specifically on women in their 50s, the concentration intensifies further, because 50 is the decade when what researchers call sandwich generation pressure reaches maximum force. Your children may still have financial needs, college, early adulthood, emergency situations. Your parents are aging into dependency. And the gravitational pull toward the woman in a family as a default caregiver is not the result of individual weakness. It is the accumulated weight of decades of social expectation, operating powerfully enough that researchers can measure it in workforce exit patterns. MetLife's Mature Market Institute published a study calculating the total lifetime financial impact of caregiving on women who exit or reduce paid employment to provide that care. The figure: $324,000 in lost wages, pension contributions, and Social Security benefits. $324,000. That is not the money spent on caregiving. That is the money that stops being earned and accumulated because hours shifted from paid work to unpaid care. But $324,000 is actually a conservative figure because it doesn't account for compounding. Let me build the math from scratch because the number gets larger when you run it forward. A 52-year-old woman earns $72,000 per year. She reduces to half-time $36,000 annually for 4 years to manage the increasing needs of an aging parent. During those 4 years, her 401k contributions dropped from the maximum she was hitting to a much lower figure. The difference in annual contributions, let's say she was putting in $18,000 per year at full salary and drops to around $6,000 part-time, is $12,000 per year in missed contributions. Over 4 years, $48,000 in contributions. That didn't happen. Assuming a 7% annualized return, which is the rough real return of a diversified equity portfolio over long historical periods, those $48,000 of missed contributions, given 15 years to compound until she reaches retirement at 67, would have grown to approximately $132,000. Not the $48,000 in missed contributions. $132,000 in future portfolio value, and that's before the Social Security impact. Those 4 years of reduced earnings land directly in her 35-year earnings history because she's 52, so the late career years are almost certainly still high-ranking years in her calculation. Lower earnings in those years directly reduce her average index monthly earnings. The SSA's benefit formula is progressive, but the reduction is still measurable. Rough estimate: cutting her income by 50% for 4 years reduces her eventual monthly benefit by somewhere between $45 and $75, depending on where those years fall in her earnings record. Over a 23-year retirement, that's between $12,400 and $20,700 in lost lifetime Social Security income. Add it together: approximately $132,000 in lost portfolio compounding, plus up to $20,000 in lost lifetime Social Security. $152,000 extracted from her retirement by a 4-year decision that was made for entirely legitimate reasons and that felt, in the moment, like the only human choice available. The invisible mortgage recorded every payment. She felt the love and the exhaustion. She did not feel the balance accumulating. Now, I want to introduce a pattern that threads through all 4 of these traps, because it changes how you think about the whole problem. The women who get hurt worst by the compounding of these 4 mechanisms are not the ones who made reckless financial choices. They're the ones who made locally rational decisions, correct in the immediate context for defensible reasons that were globally costly because of how they interacted with a system designed around a different life pattern: staying in a marriage for stability, reducing work hours for a parent who needed care, deferring investment decisions to a spouse who handled the finances, accepting a settlement without modeling its 30-year implications, claiming Social Security at 62 because the income was needed immediately, permanently locking in a benefit that is 30% lower than it would have been at 67. Each decision, understandable; in combination, catastrophic. The invisible mortgage works like a real one in one specific way. In the early years of a mortgage, most of your payment goes to interest rather than principal. You're paying a significant amount and barely reducing what you owe. The invisible mortgage operates the same way in reverse. The charges are silently compounding in the background throughout your 40s, not registering as a real cost. By the time you're 57 or 59, the principal has grown to a size that is genuinely difficult to discharge in the years remaining. Stay with me here, because this final mechanism is where everything converges, and the arithmetic becomes uncomfortable in ways I want you to actually sit with. Women in the United States live, on average, approximately 5.1 years longer than men, based on the most recent CDC mortality data. Everyone knows this abstractly. Almost nobody translates it into retirement math with real numbers. Let me do it precisely. If a man and woman both retire at 65 with $300,000 each, and both follow the conventional 4% withdrawal rule, withdrawing 4% of their initial portfolio per year, the man needs his money to last roughly 18 to 20 years. The woman needs it to last roughly 23 to 25 years. At $12,000 per year in withdrawals, those extra 4 to 5 years represent $48,000 to $60,000 in additional portfolio drawdown, which means she either depletes the portfolio sooner or she withdraws at a lower rate and lives on less money per year. Neither option is the one printed in the retirement planning pamphlet. But the 4% rule has a second problem that disproportionately affects women, and it's about sequence of returns risk. The 4% rule was established by financial researcher William Bengen in 1994 based on back-tested historical data. The mathematical premise: if you withdraw 4% per year from a diversified portfolio, historical market returns over 30 years have been sufficient to sustain the portfolio without depletion in most scenarios. The critical limitation: that 30-year window assumes you start withdrawing at the right point in a market cycle. If you retire into a significant market decline in the first 2 or 3 years, the math breaks because you're selling shares at low prices to fund withdrawals, permanently reducing the number of shares available to recover during the rebound. This is sequence of returns risk, and it's a recognized problem in retirement research. Women are disproportionately exposed to this risk for a structural reason that has nothing to do with their investing behavior or their risk tolerance. Because women more frequently take career breaks and re-enter the workforce later, they accumulate a meaningful portion of their retirement savings in their 50s later than their continuously employed male counterparts. A dollar contributed at age 33 has 32 years to compound before a 65 retirement. A dollar contributed at age 53 has 12 years. Same dollar, approximately 2.7 times the impact for the earlier contribution. Women who took even 4 or 5 years out of the workforce in their 30s are, in effect, saving structurally later dollars. And later, dollars not only compound less before retirement, they're also more likely to represent a larger fraction of the total portfolio right when withdrawals begin, increasing the sequence of returns exposure. Then there's the healthcare cost reality. Fidelity's annual retirement healthcare cost survey estimated in 2023 that a 65-year-old woman will spend approximately $157,000 on healthcare costs in retirement, compared to $143,000 for a man. The $14,000 gap is partly driven by longevity. More years means more healthcare spending, and partly by the fact that women are statistically more likely to require long-term care. The U.S. Department of Health and Human Services estimates that approximately 70% of people who turn 65 today will need some form of long-term care in their lifetimes. The average duration of long-term care use is 3 years. The average annual cost of a private room in a nursing facility in 2025 is approximately $108,000. 3 years of that, $324,000. The irony being that $324,000 is also, coincidentally, the exact figure MetLife calculated for the caregiver penalty. The women most likely to have paid the caregiver penalty are statistically in the demographic most exposed to long-term care costs. They paid to provide care. They'll pay again to receive it. And then there is the widow's income cliff, which is the mechanism that I think is the most underestimated and the least discussed of all the compounding factors in this video. When a married couple collects Social Security, 2 benefit checks come into the household each month. When one spouse dies, and statistically, in opposite-sex couples, the husband dies first, the survivor does not continue receiving both checks. She receives the higher of the two, and the lower one stops permanently. Let's put real numbers on this. A household where the husband receives $2,300 per month and the wife receives $1,450 per month is living on $3,750 in monthly Social Security income. When the husband predeceases her, which actuarial tables suggest is the more probable outcome, her monthly Social Security income drops to $2,300, a drop of roughly 39%. Meanwhile, her fixed expenses, housing, utilities, insurance, the base level of food and transportation do not drop by 39% when a spouse dies. Research on surviving spouse expenditures suggests expenses typically drop by about 20 to 30%. So income falls 39%, expenses fall maybe 25%. The gap is immediate, structural, and permanent. A 68-year-old widow managing that gap alone, potentially for another 15 to 18 years, with rising healthcare costs, a portfolio that may have already been depleted by the household's joint withdrawals, and a tax situation that suddenly shifted from married filing jointly to single. The tax brackets for single filers are narrower, meaning the same retirement income that was tax efficient in a joint return suddenly pushes into higher marginal rates, is navigating a financial scenario that her retirement plan almost certainly did not model explicitly. Here's a tax bracket point because it's worth dwelling on for a second. A married couple filing jointly can have up to $123,950 of taxable income in 2026 before hitting the 22% federal bracket. A single filer hits that same rate at $61,750. If a widow's retirement income between Social Security, 401k distributions, and any other sources totals $85,000 per year, she may be in a higher effective tax bracket as a single filer than she was as half of a married household with the same income. Nobody told her this was coming. The invisible mortgage added another line item. A financial advisor once told a client, and I mean, this was reported in an actual consumer finance interview, "Don't worry, the 4% rule has been back-tested to work for 30-year retirements." She said, "My grandmother lived to 97. He said, "Well, that's a long time." She said, "Yes, it is." He recommended an annuity. She left his office and went home and Googled variable annuity surrender charges, which is a decision that probably added $30,000 of future value to her retirement. Let me make all of this concrete with one specific scenario. Meet Diane. She is 57 years old. She was married for 24 years, past the 10-year threshold. So divorce, spousal, Social Security benefits apply. She worked full-time until she was 49, then went part-time for 5 years to manage her mother's increasing care needs, then returned to full-time work at 54. Her current salary is $63,000 per year. She and her husband divorced at 55. Her 401k balance right now is $182,000. Given the 5 years at reduced income, this is actually reasonable. She kept contributing consistently during her full-time years. Her projected Social Security benefit at full retirement age of 67 is $1,420 per month, based on her actual earnings history, including the 5 lower income years. As a divorced spouse married for more than 10 years, she technically qualifies for 50% of her ex-husband's benefit, roughly $980 per month. But since her own benefit is higher, she'll claim her own. She plans to retire at 67. That gives her 10 years to save. Maxing the catch-up contribution for workers over 50, which in 2026 sits at $30,500 annually, and assuming a 7% average annual return, she could add approximately $420,000 to her balance over 10 years. Total at retirement, roughly $602,000. $602,000 plus $1,420 monthly in Social Security. Run the longevity math. Diane's actuarial life expectancy at age 67, per the Social Security Administration's own life tables, is approximately 87.4 years. That's 20 and a half years of retirement. At the 4% withdrawal rate, $24,080 per year from the portfolio, plus $17,040 per year in Social Security. Total annual retirement income, $41,120. The Bureau of Labor Statistics Consumer Expenditure Survey shows that single-person households aged 65 to 74 spend an average of about $40,000 to $44,000 per year. Diane is technically solvent. Barely. That analysis assumes the market cooperates from day one, no bad sequence of returns in the first 3 years. It assumes no long-term care event, which has a 70% probability of occurring at some point. It assumes healthcare stays near the Fidelity baseline estimate. It assumes her tax situation remains manageable. Remove any single one of those assumptions, and the math stops working. Remove two, and she's making phone calls to her adult children. And here's the thing about Diane that matters most. She is not a cautionary tale about financial irresponsibility. She went back to full-time work after the caregiving years. She maxed contributions after the divorce. She made every adjustment the standard advice told her to make. The invisible mortgage was signed in small payments over 20 years, 5 years of reduced Social Security credits during part-time work, a divorce settlement she accepted without a forensic accountant reviewing the pension implications, a 401k balance that would have been $200,000 larger if the 5 part-time years had been full-time years with full contributions and compounding, and a retirement horizon of 20 plus years on a portfolio that standard advice calibrated for 20 years. She did everything right. The rule book she was handed was written for someone else. There is a specific genre of financial content on the internet that addresses the gender wealth gap by saying, and I'm nearly quoting verbatim from something I found last week, ladies, here are 5 ways to take control of your finances. And the first tip is make a budget. As if the entire structural architecture of the Social Security benefit formula, the pension division rules and divorce law, actuarial mortality differentials, and the tax bracket shift upon widowhood is just waiting to be overridden by a color-coded spreadsheet. The spreadsheet is not the problem. The spreadsheet would be useful if it had the right inputs. The right inputs are the 4 compounding mechanisms we've been discussing, and they're almost never combined into one model. Let me bring back the subplot I introduced earlier, the pattern of locally rational choices that compound into globally catastrophic outcomes, because understanding that pattern is actually where the practical upside lives. The women who navigate these 4 traps most successfully are not uniformly the highest earners. They're the ones who made the invisible mortgage visible before it was too late to refinance it. That means knowing the Social Security calculation before your 50s, when the high earning years are still ahead and small changes in work history still matter. It means understanding pension and 401k division implications before a divorce is finalized, not after, which requires knowing what a QDRO is and insisting one is executed correctly. It means modeling the caregiving cost in real dollar terms before accepting a reduced schedule. Not because the care decision should be purely financial, but because knowing the actual cost changes the conversation about whether other resources paid care, shared family responsibility can reduce the employment impact. And it means running a longevity-adjusted retirement projection rather than a standard 30-year one. Because for a 52-year-old woman, 30 years is not a pessimistic assumption. It is the median. None of this is secret information. It's all public. The Social Security Administration publishes its benefit formula. The IRS publishes contribution limits. Actuarial tables are freely available. But the financial advice ecosystem has almost no structural incentive to combine all 4 of these mechanisms into one conversation for one client. Because a client who understands all 4 is considerably harder to sell unnecessary products to. She's asking specific mathematical questions. Questions that require real answers, not performance. Here are 3 takeaways calibrated specifically to the compounding structure of these 4 traps, not generic retirement advice, but specific to what we covered today. First, request a full Social Security earnings history for every person in your household right now. It's free on the Social Security Administration's website, ssa.gov. Request your Social Security statement. You're looking specifically for any years where recorded earnings were zero or significantly below the typical earning level. If those years are within the range of what would normally be the 35 highest earning years, understand precisely how they affect the projected benefit. The SSA's online estimator lets you model different future earning scenarios. Most people have never done this exercise before age 60. By 60, most of the inputs are already locked in. Second, if you're approaching or advising someone approaching a divorce with more than 8 or 9 years of marriage duration, the 10-year threshold for divorce spousal Social Security benefits is not a footnote. It is worth thousands of dollars in lifetime benefits in a significant number of scenarios. Additionally, ensure that any defined benefit, pension, and any retirement accounts are covered by proper legal division orders. QDROs for 401k plans, similar instruments for pensions drafted by someone who specializes in this, not a general practitioner squeezing it into a standard divorce proceeding. The dollar amounts at stake in a gray divorce are typically large enough that this specialization is not an optional expense. Third, model the widow's income cliff explicitly as a standalone exercise. Take the 2 Social Security benefits in any partnered household, reduce the total to the larger of the 2 only, and ask whether the surviving partner can sustain their cost of living on that reduced income while also accounting for the likely shift to single filer tax brackets. If the answer is uncomfortable, there are specific strategies that address this directly. Delaying the higher earning spouse's Social Security benefit claim to maximize the survivor benefit, specific term or whole life insurance structures calibrated to bridge the Social Security gap, and annuity designs that guarantee income for a specific survivor benefit period. These are not exotic instruments. They're standard tools that require knowing the right question to ask. The invisible mortgage cannot always be fully discharged. Sometimes the payments were made too long ago, and the balance is what it is. But knowing the exact balance in dollars, not in vague worry, is the difference between a surprise foreclosure notice and a managed financial situation where the terms are understood even if the outcome isn't perfect. Lazy investing built more fortune than crypto memes. And the system that was designed for a life pattern most people no longer live, it is still running exactly as designed. It just doesn't schedule office hours to explain the fine print.